Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. Into this tutorial, I will speak about a high probability Forex chart pattern that you definitely want to know about. In fact, this pattern is quite easy to spot and is very interesting. It's kind of secret. And by the end of the video, I will try to give a complete breakdown of how to spot it, how you can potentially take advantage of it, and most importantly, what is the psychology behind that pattern. So make sure that you stick to the end of the video because this will be a very interesting tutorial. So without further ado, let's get straight into the video. Okay, so as a first thing, what we need to understand is what this pattern is and how to spot it. Then we will speak about the psychology of the pattern, and as the last step, we will speak about how we can potentially take advantage of this pattern. So let's first describe the pattern from an analytical perspective. Now, as you know, the market moves in swings. So you have a series, if you have an uptrend, you have a series of higher highs and higher lows. If you have a downtrend, you have a series of lower lows and lower highs. Now, if you are in an uptrend and at some point the market rejects the previous high, this is a rejection above previous resistance, which is now turned support. That is how an ideal uptrend is working. However, this pattern starts to get into effect and to start to present, it starts to present itself on the charts when the market fails in creating a higher high, basically printing a double top and breaks below the low. This is where this pattern starts to get very interesting because at this point, what you have is a level of previous resistance, which was turned support here. The market failed in respecting that previous resistance turned support. And currently, what you expect at that point is, since you have an M pattern, a retest of previous support and resistance, and then a rejection lower. Now, when you have a situation like this, when the market has already completed the M pattern and is currently at this zone, here you have very high probabilities for a rejection to the downside. And now we will go and see on an actual chart why is that, and I will also now speak about the psychology of this pattern. Now, when it comes to an actual chart example of this pattern, the first one that I can spot is exactly here. Now, in a situation like this, what you had was a market which was moving into an uptrend, right? You had a series of higher highs and higher lows. The market broke above. At that point, you got a retest of the previous high, rejection to the upside. However, the market then broke below this structure level, which in this case was exactly this area here. Now, once the market has broken below the structure, at that point, that previous level of daily resistance, which was in this case daily because we are on the daily time frame, but this can be on all time frames. At that point, that previous level of daily resistance, which was to turn support here, after the market broke it to the downside, was again turned resistance here. And since you have an M pattern, as I said many times, after the creation of an M pattern, what you would expect is for the market to create a move to the upside to go and complete the pattern at the previous support, turn resistance. So here in the daily time frame, we expected the market to go and retest this level, respect it as resistance, and at that point reject it to the downside, completing also this impulse correction, impulse pattern to the downside, and basically completing this entire pattern here. Now, what you will notice is that this pattern has a quite high completion rate. It's quite a high probability Forex chart pattern. So why is that? What is the psychology behind this pattern? Now, the reason for which it is so effective is that it is very effective in liquidating the biggest amount of traders as possible, creating a lot of fake moves. Because if you follow the psychology of every retail trader, what they will see is first that the market is in an uptrend. So once the market creates this bottom here, they will start buying. The market then creates this move to the upside, they will start buying again once the market breaks above the previous high. Now, since there are two types of traders, the one that will buy the breakout and the ones that will buy the retracement, right? If the market is in an uptrend, both of them will have their stop losses, which are around this area here, right? So at that point, the market breaks below this low and takes out all their stop losses, giving the possibility to market makers to actually fill in their buy orders. At that point, that is where the retracement starts. Now, once the retracement has started, at that point, a lot of traders will be looking to buy once again for the completion of the M pattern at the neckline. The problem is that when you have a situation like this where you have an uptrend, many people will say, okay, this is a double top. So after the creation of a double top, I will just start shorting. And they start shorting immediately when the market creates this candle here. And while they're shorting, you're actually seeing buying from an institutional perspective, which sometimes you even see if you look at the COT data. If, for example, you have this pattern on higher time frames, at that point, you will see the correction, which will catch them most of the times off guard, and they will either be liquidated or start closing out their positions out of panic. At that point, that is where once again you have a liquidation event on the retest of this level, which was more or less their original entry level, and at that point the market creates the move to the downside. Also, the traders that shorted the double top around this area, they as well possibly went risk-free while the market was creating the move to the downside. So they moved their stop loss at the entry price. That means that once the market goes back to the entry price, they will be liquidated out of the trade. At that point, you have even more liquidity in the market for the big players in the market to start shorting once again. And that is why you have quite a lot of confluences and manipulations that happen around this pattern, which give the possibility to this pattern to have a quite high probability completion rate. And after this move, what you expect is the rejection to the downside and for the market to complete the impulse correction, impulse pattern to the downside. So when you have the creation of this pattern, the zone inside of which you would be looking for potentially take advantage of the setup, obviously, as usual, according to the rules of your own trading plan and trading strategy, would be around this zone here. Now, this pattern, you will see it on all time frames, but depending on whether you are swing trading or day trading, you will be looking at different time frames. If you're swing trading, you will be looking at this pattern. You will try to spot this pattern, for example, on the monthly, weekly, or daily time frames, which are the best time frames from a directional perspective when you are swing trading. On the other side, if you are day trading, you would be potentially looking for this pattern on the 4-hour or on the 1-hour time frame, and then going down, for example, on the 50 minutes to actually validate your entries, because as usual in any strategy, there is the directional part and then there is the entry part. Now, I like to use higher time frames for the direction and then lower time frames to actually time the entries. But when it comes in general to develop your own trading strategy and trading plan, you would have to backtest everything. So you would have to go back in time, spotting, for example, this pattern or any other pattern that you want to integrate into your trading plan and trading strategy, and see what kind of valid entries you could potentially incorporate in your strategy around your high probability reversal zones. Now, in the case of this specific pattern, the high probability reversal zone would be exactly around this area. In the case of another pattern, it would be potentially somewhere in another area. So this is the pattern that I suggest to look into. You can backtest this pattern. You can potentially incorporate it in your own trading plan and trading strategy. I hope I was clear in explaining the psychology behind the pattern, and I hope that this tutorial was useful for you. If you enjoyed the video, make sure that you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you, and I will see you in my next video.